Great to see you, and thank you for inviting me back to this great event. We're obviously delighted that JOC is part of the IHS family, and I'm delighted personally to be sort of participating in this again as I did last year. A lot of my comments will sort of key off some of the stuff that Dr. Appel mentioned. I won't make reference to his presentation every time I do, but I think there's a lot of complementarity in what he said and what I'm about to say. I'm going to ask 3 questions and attempt to answer them. The first is, how much longer is the global economy going to stay in low gear? And related to that, what's the risk of a recession? Second question is, when can we expect trade volumes to recover? Peter Tershwell talked about that a little bit, and I think there's obviously some concerns. And then the last topic I'll touch on is risks. What should we worry about? And very importantly, what should we not worry about? And there are upside risks as well as downside risks. So let me start with this first topic, which is global growth, US growth. Are we stuck in low gear, and what's the chance of a recession? So are we stuck in low gear? Yes, probably for another year or two. What's the risk of a recession? Still pretty low. Okay, so that's the bottom line. Very interesting comment, a quote from a US CEO who said, the energy sector in the US is in recession, in depression, manufacturing in recession, but US consumer, which is 70% of the economy, doing pretty well. That encapsulates what's going on in the US rather nicely, but it could also be a statement about countries like China. China, for example, much of its industry, especially heavy industry, is in recession, but the service sectors and the consumer in China are doing fairly well. And that's what's really driving China at the moment. But let's take each of a few key countries here, one by one. First of all, the US. The US is a bright spot. And within the US, it's the consumer that's a bright spot. And consumer spending, certainly the numbers we got last Friday were extremely strong in January. But over even a 3-month period, consumer spending in the US has been strong. Best guess, consumer spending after you adjust for inflation in the US, 3%. That's really solid growth. So the consumer, again, 70% of the economy, driving growth. Another sector that's doing well is housing, driving growth as well. Not as big, but still, together they're probably about 80% of the economy. So 80% of the US doing rather well. And very, very logical reasons here. Income growth is good, jobs growth is good, interest rates are low, gasoline prices are low, putting money into people's pockets, very important. So these sectors of the economy doing well. There are negatives, 3 of them worth mentioning. The first, related to this conference, is trade. The dollar's strong, which means trade is a drag on US growth. But another way of saying that in jargon that you understand is the inbound traffic is much stronger than the outbound traffic out of US ports. Okay, so the traffic's there, it's imbalanced. So that's one negative for the US. The other is, of course, this dramatic plunge in capital spending in the energy sector because of the huge drop in oil prices. So we've had basically capital spending this year compared with 2 years ago is half what it was. So a 50% plunge, basically, in capital spending in the energy sector. And then the last but not, I wouldn't say least, but the last negative is we seem to be in the middle of something of an inventory cycle in the US. So those 3 things are dragging down growth. And this year we think 2.4% growth. Next year, as 2 of these negatives, the inventory cycle and the plunge in capital spending in the energy sector, probably dissipate, they level off at a minimum, then we'll start to see growth maybe 2.7, 2.8%. So the US, a bright spot. Now, another word about oil. You hear a lot of stories about, the conventional wisdom was, and I think still is and should be, that the big drop in oil prices net should be a positive for US growth and global growth. But recently you hear a lot of stories about the fact that no, it's a negative, or where are the positives? And let me see if I can describe it this way. The negatives happened right away. I'm talking here about the plunge in capital spending, and they were intense. This 50% drop in capital spending is intense. It's only 2% of the economy, but nevertheless, a 50% drop in 2% is a big deal. So it happened early, and it was intense, and it was visible very quickly. The positives, on the other hand, were more spread out. The way I like to describe it is, the drop in gasoline prices is the equivalent of about a $1,000 a year tax cut for consumers. But they don't get it all at once. They get it $5 here, $10 there when they go to the gas pump. So it is sort of spread out, but they're spending it, very importantly. One interesting tidbit, one interesting sort of fact is that the mortgage delinquency rate in the US is at an all-time low. Why do I bring that up? Basically what it means is the finances of consumers and households in the US have improved so much, partly because of the energy situation, that they're now able to pay their bills fairly regularly. They're not falling behind. That's really a very good indication of the positive impact of that drop in energy prices on US households. Let's move now to Europe. Europe, the news is better than it's been in the last couple of years, but there's still sort of clouds, thunder clouds, I would say, on the horizon, and unfortunately too many. Europe has been hit by what some people have called a plague of crises. Certainly Greece, but Greece seems to have sort of calmed down a little bit, somewhat. Then there's the migration crisis, although this is more of a political problem than an economic problem. It's creating huge political backlashes in Europe. But economically, actually, assuming these migrants are absorbed fairly well, big assumption, but if they're absorbed fairly well, this is actually positive for growth. And also the spending on things like housing and so forth can boost growth. The economics are simpler and more positive. The politics are very complicated and nasty and potentially very dangerous. The third big risk is, of course, what's called Brexit, which is the referendum in June over whether or not Britain stays in the European Union or not. Our best guess is chance of a Brexit, probability of a Brexit is only between 35 and 40%. But were it to happen, and I'll talk about this when I talk about risks a little bit, it could be quite problematic. So Europe doing better, no question, and consumers are playing their role, but facing these what I'll call thunderclouds. Japan, I'm not going to spend much time on. Japan just seems to have a lot of trouble gaining traction. 1 quarter positive, 1 quarter negative, 1 quarter positive, 1 quarter negative. I think they're going to be stuck in that for a while. But then let's come to China, which of course, again, as Peter mentioned, I talked about last year, but I'll talk again about this year. One way to understand what's going on in China, China's been sort of center stage, especially in financial markets. Excuse me. 3 things going on in China, one of which I talked about, 2 of which I guess I talked about last year. The first is, of course, China is facing major structural problems. What you had is this explosion in debt, which I talked about last year and Peter mentioned again, which financed 2 things. A real estate bubble, which is deflating in some sense, maybe bursting. But much, much more troubling is this huge expansion in industrial capacity, including shipbuilding. But just to give you one interesting statistic, and I'll focus on the steel industry here, capacity utilization in the steel industry is 70%. In other words, that's very low by anybody's standards. The remaining excess capacity, that 30%, is the equivalent of the steel production combined, US, Germany, Japan. That gives you some sense, just in that one industry, of how much excess capacity there is in China. The resolution of that excess capacity is likely to hold down growth for quite some time in China. The second problem in China has to do with slowing growth. Some of this is because of the problem I just mentioned, but some of it is demographics. Again, Dr. Appel mentioned demographics. China's population is one of the most rapidly aging populations in the world. Its labor force is declining. And so Chinese growth is falling and has been falling for some time and will continue to fall for some time. I mean, the best, say 10 years from now, the best China growth can do is 5%. Now, having said that, China is a much bigger economy now than it was 10, 15 years ago. So its weight in the global economy is much bigger. So 5% growth, let's say, is the equivalent of 10, 15%, say, 15 years ago. So we just have to keep that in mind. The last problem in China is what I'll call the ineptitude of the policymakers. 2 episodes, last August and again in January, the response of the Chinese government to the sharp drops in stock prices was rather chaotic, rather panic-stricken, one has to say, which led to concerns about, you heard a lot of this in the marketplace, why are they panicked? Why are they behaving like this? What do they know we don't know? And I think that we heard this in Davos as well. I was in Davos as well, and we heard this a little bit. It's like, why are they doing this? The other thing happened in, again, August and in January as well. In the middle of a stock market rout, they widened the band around their currency, and the currency dropped. It didn't drop by much, but why they chose to do it then rather than when markets were calmer is a huge puzzle. Again, we shake our heads. What are they thinking? Why are they doing this? It's almost like they don't understand their role in global financial markets, and that's rather troubling. But one way to sort of understand what's going on in China is what I hinted at earlier, which is the Chinese industrial sectors, especially heavy industry, are in recession. That certainly explains why their demand for industrial materials is so low and so weak, and why commodity prices have dropped as much. So Chinese industrial sector, especially heavy industry and mining, in recession. But the service sectors and consumer spending are actually doing fairly well. So if you look sort of down deeper into the Chinese statistics, what you see is growth of 8%, let's say, in consumer spending and services. So we have to start thinking more about China as an economy that's being led in time increasingly by the service sector and less by the industrial sector. So that said, Chinese growth, if you believe the official statistics, we think 6.5% growth. If you don't believe it, it's more like 4, 5%. But even that's pretty decent. Most countries would love to see 4 or 5% growth. So let's just be clear about that. There are other bright spots that I can we can talk about a little bit. India is one of them. India is probably going to grow 7.5%. So from that perspective, there are other bright spots. In terms of the global economy, yes, we think this year it's going to be another year in which we're stuck in low gear. Global growth, we think this year around 2.5%. Last 4 years, it's been stuck between 2.5 and 2.7. We think this is another year of that. But we think the probability of a global recession is only somewhere in the 20 to 25% range. So that answers the first question. Second question is, will trade recover anytime soon? And the answer is probably not this year, maybe next year or the year after, but probably not to the rates that we saw, growth rates that we saw in the 1990s or the 2000s. Just to remind you, volume growth in terms of global trade was around 7% for almost 2 decades. That was twice GDP growth. Recently, it's been around 2%, which is less than GDP growth. So what's going on here? There are 2 kinds of factors that are driving this slowdown in trade growth. One is cyclical and one is structural, or some of them are cyclical, some of them are structural. Let's look at the cyclical first. And I would say the cyclical drivers of weaker trade growth are probably account for 50, maybe as much as 70% of the drop. Clearly, weak global demand, this very long, extended period of sluggish growth, is part of the answer. And in particular, the Chinese industrial recession is very much a part of the answer. I mean, if you look at import growth in 2015, Chinese import growth in 2015 is minus 13%. Right there, that tells you that the drive, that the pull, if you will, from China is gone. It's in reverse. A big deal. That's a huge deal in terms of trade growth. Now, and then that's related to that, of course, is the huge drop in commodity prices. Huge. Again, 50% or so drop in commodity prices, oil and other commodities. Now, there's sort of value and volume implications of this. Obviously, in value terms, because of this huge plunge in commodity prices, in value terms, trade is a big negative. But in volume terms, it's still depending on what statistics you look at, just slightly positive. As I said, some numbers suggest around 2%. Now, will this reverse? Of course it will. We're not going to continue to see these kinds of plunges in commodity prices. In fact, if anything, they've leveled off recently, so we'll start to see commodity prices start to come up. Same thing in China. Probably the drag from China, especially the industrial recession, will begin to ease a little bit. And growth, in a lot of economies around the world will begin to ease. I mean, two economies I haven't mentioned, which are actually in recession, are Brazil and Russia. We think by next year, the recessions in those economies will probably ease as well. So what we're going to see, is some improvement in global growth prospects next year, the year after. That will help trade growth. So in that sense, from the cyclical reasons, there will be a recovery in trade growth. What about the structural reasons? And here, I think we have sort of negatives and some positives, but the negatives will not necessarily reverse themselves, and I think it's important to point that out. The first is what I mentioned earlier, which is the transition of China from an industrial economy to a service-based economy. That will continue to change. It will continue to evolve. As it does, China's role in terms of global trade patterns will change and diminish in some sense. So I think that's very important. This is a long-term trend. It's not a short-term trend. Second thing that we're beginning to observe is a shortening of the supply chains, or another way of saying it is a big drop in intermediate goods trade. Now, that's not necessarily a bad thing in the sense that, what we're seeing is a lot of producers producing in the market for the market. In other words, let's say in China for China, or in India for India. Again, I think one of the things that's going on is that the big gains from transportation, from the internet and so forth, I wouldn't say are behind us, but they're not going to be quite as big going forward. And in particular, what we're seeing is with wage increases in places like China or even India, the cost advantage of producing, let's say in China, to export elsewhere is beginning to diminish. So the big era of globalization, especially that we saw in the 1990s and 2000s, may indeed be behind us. Whether that will recover is a little hard to tell, but it's likely to be behind us. Two other things. Well, one other thing. Two. Let's mention is that one of the big changes that's occurring in terms of global integration is via data, via information flows, via bits and bytes, as it were. One very nice example of this, and it's not a pervasive change, but it is changing, and so will have implications for trade, container trade in particular, is one sort of neat example is rather than shipping DVDs, or rather than buying DVDs, consumers are downloading or watching movies in terms of streaming online. That's just one example. There are others. So the nature of trade is beginning to change as well. More data-driven in some sense, more information-driven, more online-driven in terms of the products themselves, not so much the buying, but and less in terms of shipping. So I think that has implications. I think, again, Dr. Appel answered a question about 3D printing, but coming are things like 3D printing, the Internet of Things, artificial intelligence. We don't really know what the implications of these are, but it clearly is going to transform at some level manufacturing and will transform trade and transportation. Now, there are upsides. I don't want to be too negative because I think there definitely are upsides. One is free trade agreements. We, again, touched on that. The TPP, I agree, will not be passed before the election. Could be passed in a lame duck session of Congress. That's possible. But certainly it has a positive impact on trade and growth. Not huge, but like all free trade agreements, it tends to have a small positive effect that accumulates over time. So that's an upside. The other upside is that, in fact, we know that middle-class populations in the emerging world are growing. Their needs are growing. That's going to create demand for products, for goods, for things, and that will be good for trade. About half the world, we talk about the connectedness index that DHL has, half the world is not that well connected. That will change in time. That increased connectedness will also mean an upside risk for trade volumes. So it's not all, the point I'm making here is not all negative. So in terms of trade growth, as I mentioned, around 2% by some measures this year. In about 2 years' time, I would expect it to go up to about 3 to 4%. I honestly don't think in this environment we're going to get back to 7%. I think there were some unique features of the 1990s and 2000s. But trade will become an engine of growth again, but not as strong as it was in the past. So let me wrap up by talking about risks a little bit, and what we should worry about and what we shouldn't worry about. One thing we shouldn't worry about is the stock market. Now, I say that and people say, okay, the stock market's taken a big hit. But in terms of economic growth, recent studies and analysis done by, of all places, the Federal Reserve, showed that the stock market predicted 23 of the last 8 recessions. Okay? So, the point is that there's a lot of financial volatility. Doesn't necessarily mean the economy is suffering. And in fact, I think Dr. Appel mentioned this. In Davos, a lot of CEOs scratching their heads saying, my company's doing okay, my industry is doing okay, why is the stock market doing what it's doing? The other puzzle is why oil prices and the stock market are positively correlated. So oil prices go down, stock market goes down. Oil prices go up, the stock market goes up. Now, you can say, well, this is maybe the canary in the mine in this sense, that if a drop in oil prices signals a collapse in energy demand, I get it. But that's not what's happening here. Energy demand is still positive and reasonably strong. The issue in the oil market is the supply side. There's too much supply, more coming on stream with the removal of the Iran sanctions. So that's good news for the consumers, for the US, for Europe, for Japan, for India. So it's one of those things that just doesn't make sense. And I think there's clearly a big fear factor in financial markets. And sort of, I often joke that there are episodes in the stock market where all news is good news regardless of how bad it is, or all news is bad news regardless of how good it is. And I think we seem to be in the second of those periods here. So I'm not terribly worried about the stock market here in terms of its impact on growth. And frankly, I mean, a lot of studies have been done in terms of what's called the wealth effect. It's very small. It's very tiny. So assuming even the stock market goes down further, it's probably not going to have a big effect on growth. It certainly won't drive things into recession. I'm going to focus on 3 other negatives and a couple of positives very quickly. China, back to China. I think the big worry about China right now that you hear a lot about is the risk of a big devaluation. The renminbi has already fallen about 6% since August, approximately. The worry is that there's massive amounts of capital fleeing China, roughly $1 trillion worth of capital. That's huge over the last year. What has China done? China's done 2 things. It's allowed the currency to come down a little bit, 6%, as I said. But it's also pulled down its reserves quite substantially. It used to have about $4 trillion in foreign exchange reserves, and Peter Leach mentioned that I had said it last year. But it's already reduced that by about 20%. So it's now just barely over $3 trillion. There are limits to how much China can reduce its reserves in an attempt to sort of offset this capital flight. And the third thing it can do, which it probably will and it implicitly already has, is reimpose capital controls. There's a lot I could say about that, but let's stop. The worry is that China might be forced, China does not want to do this, but China might be forced to let the currency go. And if it goes, it'll go about 20% or so, something of that order of magnitude. That could be a huge shock to the global economy. That could be the beginning of a currency war. But I would assess the risks of that as certainly 15 to 20% at the very most, not even that. Because it would hurt China, in a sense, more than it would hurt the rest of the world. So I don't think that's going to happen, but it is a risk. I mean, it's a risk, it's a worry. The other one is Brexit, I mentioned earlier. 2 scenarios with Brexit. What's called a hard exit, which means one in which the negotiations, the new negotiations about Britain's role and its relations with the European Union would be very difficult, very contentious, and in which Britain would get punished in some sense. That would hurt trade growth in Europe and in Britain. It would probably trigger a departure by Scotland. In other words, Scotland would actually leave the United Kingdom. It would be a very nasty scenario. The other is a soft exit, one in which Britain would have a relationship with the European Union very similar to Switzerland and Norway. That is not a bad scenario. The first one is a very bad scenario. And the last negative, of course, is US politics. And the negative aspects of that are, of course, two of the candidates, Trump and Sanders, are anti-global. Both of them have said very, very negative things about globalization, about free trade. So that's a serious concern. Last comment here, I don't want to be totally negative because there are upside risks here. There are upside risks in terms of growth. There's a lot of pent-up demand in the US for housing, for capital spending, a lot of pent-up demand for consumption in Europe, so that we could actually see stronger growth. And the other positive is that we've seen an explosion of new technologies, but it hasn't shown up in our productivity statistics, either here or elsewhere. And there's often a lag between new technologies and productivity. So it could be in the next 3 to 5 years, we'll actually see a lot more upside in terms of productivity growth. And that could be very good news. So on that happier note, let me stop. Thank you all very much.